on TV, online and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and this is Talk Your Book, and today we're lucky to be joined by Bob Desmond of Clemont Global for the first time. Bob, thanks very much for coming on the show.
Hi, Chris.
Now, I thought to start off with, maybe could you just give us a brief outline of Clemont Global and how you guys look to invest?
Yeah, we're a global fund manager, Chris. I think we're somewhat unique in that we only focus on 10 to 15 businesses in the portfolio. And if you've got such a focused portfolio, you obviously have to focus really on the highest quality businesses, which we do. And being so focused, we do exclude large parts of the market. And that could be anything that's leveraged, something like banks, cyclical. We don't do resources. We don't do complicated, so we don't do pharma or biotech. We take out commoditized, sort of low margin businesses. We don't like regulation, so we don't do utilities. So where we tend to end up is what we call financial plumbing, something like a Visa. Healthcare, we don't do pharmaceuticals, but we do like other parts of the market, precision instruments or animal healthcare. And then we do like technology, but we kind of think of it what I call easy tech, something like Microsoft. We don't do sexy tech, if you like. And then we do have other parts with business services and industrials, and that's kind of all we're really ever going to be in. About 1.5 billion, strategy's been going since 2011. So that's us.
And I know you're renowned as bottom-up stock pickers as opposed to top-down macro strategists, so you probably won't have a view on the market overall. But how are you seeing perhaps valuations and the number of companies that are passing your valuation screens where you're able to dig a little deeper in?
Yeah, I mean, just in our small subset, Chris, so we have, a watch list of about 200 companies, and then we have our approved list, which is companies we would buy today at the right price, which is about 40 names, and then the portfolio is 10 to 15. I think it is 13 at the moment. So just in our little subset, I would say the wish list is not that, it's fairly short at the moment. One of the things we use to kind of gauge the sentiment of where things are at is we have a valuation for every business in the portfolio. And then we measure the price today versus that valuation. We track that through time. And we use the same inputs always. We never change the discount rate. It's always 60%. And the market multiples we use are 20-year averages. So the same inputs. And that gives us a gauge of where we're at. And the long run average of that number has been around 10% discount to our estimated value. And currently that's sitting around an 8% discount to our estimated value. So that's normally gives me a gauge of where we're at. I could look at the 10-year PE, where that sits at the moment. That sits just around the long run average. So, we're not, as I say to clients, we're not in December 21, the back end of COVID, but we're also not in, the bargain basement that we were in October 22, probably sitting somewhere in between.
And what stock did you want to talk about today?
The only thing I was going to add to that, Chris, is when everyone starts talking about Bitcoin, I take note of that. It seems to be the new VIX. When everyone's feeling really good, we start talking about Bitcoin, and then it disappears when everyone feels depressed. I just find it amusing, actually.
Well, I'm hoping it's a forward-looking liquidity indicator that filters into equities and eventually small caps, but it's certainly ripping at the minute. And what stock did you want to talk about today, Bob?
So a company I want to talk about today is called Agilent. It's based in the States. It's a life sciences business based in California, something we've owned for about 4 years now.
And talk us through the journey since you've owned it, or the historical performance of that company. It looks like it's been a pretty consistent performer over a number of years.
Yeah, it's a very steady business, Chris. As I said, large parts of healthcare we don't really like being in, med tech and pharma and biotech, just because of the complexity. But something like Agilent, it's a way of being in healthcare. It's the picks and shovels, if you like. So they sell equipment to about 265,000 labs around the world. And those instruments go into the labs and help scientists analyze matter and break down molecules and all of those exciting things. So it's a razor blade model. You sell the instruments, and then behind that you have a very nice consumables and services business, and we like that. So that's kind of the essence of the business, kind of across three different divisions. So the main, the core business, which is the life sciences business, is about 60% of the revenue, which is really the instruments and consumables. Then you've got about 20% in Agilent Cross Labs, which is probably the fastest growing, highest margin, which is the installation, maintenance, repair part of the business. And there the attach rate is sitting around 30%. Compared to some of their peers, which are up in the 50s. So it's a nice tailwind growth for the business. And then you've got their diagnostics and genomics business, which is around 20% of the business. So it kind of breaks down to three nice divisions. Life sciences grows somewhere around about mid-single digit. If you actually grow in the faster growing Cross Labs, which is probably high single digit. And then diagnostics and genomics, depending on where you are, it's a bit more cyclical, would be mid-single digit to high single digit. So overall, got a company growing in that sort of 6-7% area top line.
And is there a particular division that you're most excited about going forward, or you sort of rank them all equally in terms of importance in the next, let's call it 24 months?
I think the probably the best, the most exciting would be the Cross Labs, because it is the fastest growing. It's also the highest margin, so it has a nice mix impact. Their attach rates are still lower than some of their peers, so there's a nice tailwind there. And it's a simple business, really. It's just going in there, installation, repair, maintenance. Obviously, we like the consumables part in life sciences as well, so it's got very nice recurring revenue there. To diagnostics and genomics, when everything's funding is really running hot, and some parts of biotech and pharma. That tends to grow a lot quicker. Then it tends to be more cyclical as well. When things slow down, it grows slower. So it's just a nice business. Probably Cross Labs would be my favourite though of the three.
And quite geographically diverse. And in some of their commentary and their results, they've had some softness coming out of their China exposure. How are you viewing that going forward?
It is one of the things I do like about Agilent. Actually, it is roughly a third between the US. Europe and Asia. The China business is quite a big one. It's about 20% of revenue, so that's higher than for some of our other businesses. China has been soft for them. It's a market that tends to rely more on stimulus, so that's been a bit softer, and especially in their their pharma business, that has been quite soft. But it's stabilizing now, but sort of bumping along the bottom, and there are sort of some signs of, and across the whole business, actually, it has been tough because a lot of spend went in during COVID, and some of those, replacement cycles were brought forward, if you like. So they had comps into the double digit, which is higher than they normally do. And so we've kind of at the back end of that and working our way through that. And I think, book to bill is actually running above 1 now, so that's good, and there are signs of stabilization. So we'd probably expect to kind of work through that, and towards the end of this year kind of be exiting and hopefully going into FY25 at their normal cadence of 6 to 7% top line.
And there's been a reasonably recent CEO transition from an ex-CEO who was there for an extended period. How are you feeling about that, and what sort of things do you look out for when there is a CEO transition to make sure that it's going as smoothly as you hope?
Yeah, good question, Chris. I think the CEO he was pretty much a lifer. He'd been there for 40 years. He was instrumental in, I think, really focusing the business. They spun out, in 2015. A more cyclical business was spun out. It's actually quite an interesting story. Agilent, its background originally, it was part of HP, but Mike had been there for a long period of time. But it's good that the person taking over has also been at Agilent. I think 26 years, was previously COO, and he's also run the CrossLab business. So I think he's been there. He's been quite involved with the M&A. He's seen what works, what doesn't work. So my preference for, when someone comes in, he's someone internal, someone who's worked closely with the CEO, someone who understands where mistakes have been made in M&A or culture or cost out, or, who's been there a long period of time, because all businesses have their natural sort of cycles. And someone who's seen those, I think, is a good replacement. And also every business has its own culture. So the fact that he's been there, and Mike was very, very big on culture, I think he's a really, really good replacement, and we're happy with the succession.
And talk us through broadly the numbers, how you view a business like this, whether your main focus is on revenue growth, margins, what are the catalysts that get you excited, and why Clemont Global invested in a business like this?
So if I go to our kind of checklist, Chris, we're looking for businesses. We don't have to be what I call go-go growth. They can grow their top line, call it 5% organic, that have high margins, high returns on invested capital, good cash conversion, and strong balance sheets. So if you kind of go through those numbers for Agilent, through the cycle, normally they don't have that much of a cycle, but obviously COVID did kind of mess up the numbers a bit, but probably you're looking at a 6 or 7% organic growth story over the next 3 to 5 years. The operating margin sits around 27%. Every year they tend to get 50 to 100 basis points of margin improvement, and they tend to buy back some of their stock every year. So you're looking through a cycle and through a 3 to 5 year period, low double-digit earnings growth. They have done better than that historically, but I think it'll probably be in that sort of range. They've always run a strong balance sheet, less debt to EBITDA of less than 1, and their cash conversion sits sort of in the mid-90s. So it ticks all those kind of the boxes from a number point of view. They've got to have good capital allocation. I think the management's solid. So then you kind of end up on the valuation piece. So going back to your first question, through COVID, this was very, very strong. We almost exited the stock completely because the valuation had got fairly full. We kind of built that position again as it's kind of been going through the back end of COVID. It's reasonably full position now. Its multiple sits around 24, 25 times earnings, which is pretty much bang in line with its long-term average. So if that can sit where it is, we get the earnings growth and the dividend yield, you're looking at sort of 11, 12, 13% total return. That's kind of what we're looking for from this business. And we target 8 to 12% through the cycle for the whole portfolio. So this one's kind of ticking those boxes.
It's a little bit less spicy than a lot of the small caps we get presented on this show, Bob, but certainly a very institutional grade investment and presented brilliantly by yourself. So, mate, thanks very much for coming on Talk Your Book.
Thanks, Chris. Thanks for having me on.
Thanks, Bob.